With the shares of First Republic Bank down almost 96% over the past year, a lot of you guys have been asking me, especially like you guys have been emailing me and asking, is it time to purchase shares in First Republic Bank? And, the short answer is probably not, but I'm going to walk you guys through the analysis. But I'm also going to show you that, I've done a ton of research on other banks and there are some opportunities in this environment. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now, the Wall Street Journal did do a good job in sort of like summarizing the whole First Republic issue, and so let's start with that. So effectively, the Wall Street Journal is saying that, when it comes to the problems that we're dealing with at First Republic, there isn't really an easy solution. Now, I disagree. I think there is an easy solution. The solution is essentially just wiping out the shareholders, but they're saying that if you do a regulatory seizure, it would bring its own set of problems. And so let's sort of dive into exactly what the issues are and what the potential remedies are, and then at the end of this video I'm going to go into areas where I'm potentially seeing some opportunity. And so a lot of people are making the mistake that they're saying that because First Republic's shares dropped considerably just this past week, it dropped on old news, and I would say that that's incorrect, and here's why. If you notice their total deposits in Q1, so there's March 31st of 2023, their total deposits are $100 million. Compare that to their total loans, $173 million. You have a loan to deposit ratio of 166%. Now, people didn't really realize or didn't think that the loans or the deposits would drop that much, because remember, in here is $30 billion that was deposited by the other major banks. It was sort of like a de facto bailout orchestrated by Janet Yellen. And so when you take that $30 billion out of here, what you really have is an almost $100 billion outflow of deposits. Now, the loans have remained on the balance sheet, but the problem is that now that sort of depositors are seeing that there is a keyboard run on the bank, how much more of the deposits are going to leave in Q2? And so does this put them in a situation where they're going to have to start selling off assets at huge discounts to sort of address this? And how long until this book value of $76.97 per share gets wiped out completely? And so, there's a big risk here. I would say that they need at least another 70 billion, not million. I would say that they need at least another $70 billion injection, because when the depositors see this, they'll probably move more of their money. And the other thing that I do want to point out is notice their net interest margin has pretty much collapsed. I mean, not necessarily collapsed, but it's come down considerably. And the reason for which is notice their short-term borrowings, how that has increased as a result of them trying to sort of like handle the outflow of depositors. And so, the other solution that they have is they just have they just continue to rely on wholesale borrowings so that they can shore up the depositors that are leaving. But that, of course, will essentially destroy any sort of net interest margin, maybe even put you into a negative margin if your loans are earning a lower interest than what you're having to pay on new deposits. Remember, these loans were made when the interest rate environment was much lower, so you can absolutely go into a negative net interest margin. And so once again, that could potentially wipe you out. Now, I don't know exactly how this looks going into the future. I'm not an expert on First Republic, but I just see a ton of risk here. When I look at this, I immediately say, big yikes. I'm going to stay away from this name. And, let's see how this plays out, but it's not something that I'm going to be deploying my capital into. Now, the Wall Street Journal goes on to say that any solution for First Republic Bank would likely require assistance from regulators, the government, or other lenders. Of course, right? You need assistance from somewhere. They're not just going to continue to be able to borrow at the wholesale level. I think that inevitably puts the bank out of business as well, like I showed you with the net interest margin continuing to go down. And so, they disclosed on Monday that they had lost about $100 billion in deposits. And I showed you guys that because you're seeing a $70 billion reduction in the number of in the amount of deposits, but then that $30 billion of that is actually that bailout or the de facto bailout. And so once you deduct that, you realize that they actually did lose $100 billion. And so this is that bailout. 11 banks deposited 30 billion with First Republic last month in hopes of stabilizing it. I don't think it did the trick. And how did it get into this issue? Well, this is where I don't know a lot about First Republic, but the Wall Street Journal did report it. They said that First Republic's specialized in making huge mortgages, often at low rates, to wealthy borrowers, and that business model essentially no longer works. And so they're sitting on a ton of loans that are mispriced for the current interest rate environment. In other words, they made these loans at low interest rates, and of course the interest rates have shot up, and so effectively you'd have like these unrealized losses on these assets. But what this tells me is that it looks like First Republic's problems seem largely to be bank specific. This is not an indication that there is a pervasive risk in the market. And so you really have to look at, and this is where this becomes sort of like a value investors area, because you really have to dive deep into the story for every specific bank and determine which ones are shielded from this risk and potential other risks on the horizon, which I do talk about, and I'll mention that a little bit later in this video, and see if they can sort of like navigate. So this is perfect for a value investor right now. The regional and national banking institutions, there could absolutely be some opportunity right now, because there's a very high likelihood that the baby could be thrown out with the bathwater in this environment. And of course, the shares being down 96%, it's effectively telling you that the stock market is saying that First Republic is nearly worthless in its current state, and I agree. Now, I'm not going to try and speculate that somebody's going to come and bail them out, whether it be a government or wherever, because the risk is too high that the shareholders are going to get wiped out. Look, the depositors will be fine, but people are less sympathetic to the shareholders. And so I do believe that there's a high likelihood that the shareholders get wiped out. And so this is a main reason why I'm just not going to be allocating my capital to First Republic. And so many people believe that the FDIC might ultimately be able to provide assistance only, if they seize the bank, wipe out the shareholders, and replace management. And the only way that they'll do that is if they use a tool called a systemic risk exception that allowed the agency to guarantee all the depositors at the other two failed institutions that we saw last month. Of course they'll do that if they have to, and it looks like they're getting closer and closer to do that. Now, here's where I disagree with the Wall Street Journal. They're saying if the FDIC doesn't make the depositors whole, it could reignite questions about such deposits at other regional banks, causing customers to yank their deposits from smaller firms. But if it does help the First Republic Bank, the FDIC could be accused of bailing out Wall Street. And so here's my question. Is it really bailing out Wall Street if the bank is seized, the shareholders are wiped, and the management is fired? I think that that's a much better solution than, creating systemic risk in the banking industry. So I don't see this as a tough decision. You do what you have to do to stabilize the economy. Now, here's the thing. During my time away, I actually, although I was sick, I still was able to be awake, a few hours every day while I was sort of like recovering from COVID. And what I did was I actually pulled the financial statements for 63 national and regional banks, and then I compared them to one another using 9 key performance or risk indicators. Some of the more important ones would be, your tier 1 ratio, your loans to deposits in this environment, the rate at which they've historically grown book value per share, their efficiency ratio, their net interest margin relative to how they issue loans, and, just the overall diversification of their loan portfolio. And then, of course, just looking at their charge-offs relative to their allowance, because I think that's important, and just like historical performance. So, there's a lot of key performance indicators that I use to compare the banks. And then what I did was I tiered them off into, like the highest tier, the mid-tier, etc. And then from there, what I did was I actually went in and completely researched the institution and found out what the real story was, what made that particular bank special, and what is the likelihood of that that bank to sort of like address risks into the future, like some risks that I see coming, like for example, risks with office real estate, etc. And so, there was a lot of analysis done here. And then I didn't stop at that. I actually met with the Patreons and we did a 2.5 hour live course where I reviewed exactly what the key performance indicators were, like all 9 of those, and what they mean for the banks. And then we applied those key performance indicators to the banks as we analyzed them. And then what I did was I provided my personal ranking of the banks that I analyzed. And it gave sort of like everyone an idea of sort of like at least how I did it. And then, they can go and of course analyze and rank the banks themselves. And so there was a lot of work done here. Now the question is, how do you get access to this special live course and that tracker for the comparables where I compared the banks to one another? Well, you can get access to the special live courses and the comps schedule, which is the comparative analysis of the banking industry using the most important key performance indicators, at the higher tier of the Patreon. And right now there's over 200 Patreons that have joined us, and many of them are at the lower tier where you get access to all of my research on the tracker. But I always like to say that the best value is the monthly live economic calls that I have, and then of course the special live courses and the comp schedule. And the other thing that I would like to point out, and I always point this out, is that the most important value that you can get from this channel is that Q&A series. And if you haven't seen the Q&A series, we cover some very important topics and I go very deep into sort of like explaining them, and you can get access to that whole series right here.